Welcome back. Let's talk about petty cash. Recall the inventory purchase process I described in the inventory controls video. If a department needs to purchase something, it'll notify the purchasing department. For instance, if the sales department needs some more office supplies, it'll fill out a purchase requisition and send it to purchasing. Purchasing will use that requisition to create a purchase order. The purchase order serves as the actual request to purchase said item or items from the seller. A copy of that purchase order will be sent to the selling company to initiate the purchase. The purchasing department will also make another copy of the PO and send it to accounting. Upon receiving and processing the PO, the selling company will generate a sales invoice which will be sent back to the buying company's purchasing department as an order confirmation. Of course, the sales department will also keep a copy of the invoice for its own records. The purchasing department will then make a copy of the invoice and send it to the accounting department to be matched with the purchase order. Eventually, the item will be shipped to the buying company's receiving department. With the delivery, the item will include a receiving report that details what items are contained within the shipment. Receiving will then make a copy of the receiving report and send it to accounting. Accounting now has no less than 3 documents to reconcile what was ordered to what was purchased to what was received. With the amounts verified and entered into the system, the payment can be made, most likely via a Treasury department. Treasury departments are responsible for making cash disbursements and collecting cash receipts. Remember, to safeguard assets like cash, we need to separate the asset record keeping from asset custody. In this example, accounting handles the record keeping, and the Treasury Department handles asset custody. If anyone in the Treasury Department were to embezzle any funds, the Accounting Department would identify the resulting discrepancy when doing its reconciliations and investigate it. Back to making the payment. Accounting will send copies of the purchase order, invoice, and receiving report to the Treasury Department. And the Treasury Department will authorize and initiate the payments to the vendor, most likely via an EFT. The vendor will almost certainly receive the payment through its own Treasury Department. The advantage of this process is obviously security and accuracy. At numerous points, what was purchased is matched to what was ordered, which is matched to what was entered into the system, all of which supports the cash disbursement. If anyone tries to swindle those funds, the theft will be noticed and the culprit will likely be caught. What's the drawback of this process for controlling cash payments? The answer is time. From requesting the purchase to paying for it, anywhere from a few days to even a few weeks could pass. What if you need to purchase something immediately? What if the copier breaks, or you need to order a lunch for a meeting for the following day, and you can't wait 10 days for approval? For that, we have petty cash. Petty cash is physical cash kept in the office. Having actual physical currency on hand allows a company to make immediate purchases and bypass the wait time of the previously described approval process. Of course, having physical cash necessitates some security protocols to protect against theft, which we'll now cover. Let's book some entries and describe what they represent. To establish a petty cash fund, we would debit petty cash and credit cash for whatever amount we choose, say $300. In this case, we've decided to keep $300 of physical currency in the office for incidental expenditures. To elaborate, we sent one of our employees or co-workers to the bank, where he or she cashed a check on behalf of the company, or maybe withdrew money from an ATM using a company card. In either case, he's taking $300 of physical cash out of the bank and bringing it back to the office. Once he returns, he puts that money in a lockable cash box. I couldn't find an icon for a cash box, so I chose a safe, but the idea is the same. Back to the entry, we credited cash because those funds are no longer in the company bank account. They're in the office in the cash box, represented by our debit to petty cash. This is the entry for establishing petty cash. The only time we'll ever debit or credit petty cash is when we establish it or change its balance. I'll cover this momentarily. Let's clarify what happens as we use the money in the cash box. Every time someone takes money out of the box, he or she must fill out a petty cash disbursement report, explaining for what the cash is being used. He or she then puts the receipt back in the box to substantiate the amount on the report. For example, on the 2nd, someone takes out $70 to purchase office supplies. He'll bring the receipt back to the cash box, or more likely, the cash box's custodian. He'll fill out the disbursement report and put the receipt back in the box. On the 11th, the printer breaks and we call a repairman. The repair costs $110, so we take that amount out of the box, use the receipt to fill out the disbursement report, and put the receipt back in the box. On the 18th, we ordered a catered lunch for an all-day meeting, which cost $85. We take the money out of the cash box to pay the caterer, use the receipt to fill out the disbursement report, and put the receipt back in the box. On the 22nd, we have to express ship some legal documents for $18. Take $18 out of the cash box, use the receipt to fill out the disbursement report, and put the receipt in the cash box. Finally, on the 29th, we have to purchase some postage stamps for $14. Wash, rinse, and repeat. Take the money out of the box, use the receipt to fill out the report, and put the receipt in the box. At the end of the period, the cash box custodian will take out all of the receipts along with the cash remaining in the box and total everything up. Obviously, however much cash we have left is what we have left, and the receipts represent how much was taken out of the box. Consequently, all these amounts totaled together should equal the petty cash fund balance. For example, let's imagine at the end of the month we have $3 left in the box. We obviously need to replenish the cash box, and we can do so as follows. All the amounts on the disbursement report will become debits in the journal entry. Remember that these amounts represent assets purchased or expenses incurred. all of which get debits. However, these items have only been recorded in the disbursements report, not the ledger. So we need to do so here. For starters, we'll debit office supplies for $84. This item is the sum of the $70 of supplies purchased on the 2nd, plus the $14 of supplies purchased on the 29th. If you like, you could show these two amounts on separate lines. The printer repair would likely go to a repairs and maintenance expense account. The catered lunch would probably go to some sort of miscellaneous expense account. As for Federal Express, that charge would probably go to delivery expense. Now we have our debits. Our credit will go to cash in the amount of $297. Remember, our credit to cash represents the money we're taking out of the bank to put in the box. The $297 is the difference between our petty cash fund balance of $300 and the actual amount of cash in the box. We only need to take out just enough money to make the cash in the box equal the fund balance. At this point, we can verify that our entry's total debits equals our total credits, so all is well. To corroborate, if we sum the $3 of cash left in the box with the amounts on our receipts, aka the amounts taken out of the box, they sum to $300, the fund balance. What if instead of $3 left in the cash box, there's only $2? The debits of our entry will remain unchanged. Those are still the amounts on the receipts, and they need to be debited to the appropriate accounts. Our credit to cash will instead be $298. Our fund balance of $300 less the actual amount of cash in the box. Remember, $298 is the amount we have to take out of the bank and put back in the box to get it back to $300. Now we have a problem in that we have $298 in credits, but we still have $297 in debits. To fix this, we're going to plug $1 to cash shorten over. Just as we did in our sales journal entries. Now we're in balance. Again, you can verify that we indeed have a shortage by summing the cash remaining in the box with the amounts on the receipts. In this instance, they sum to $299, $1 short of our fund balance. Our employee was likely shortchanged in one of those purchases. In either case, we have too little money in the cash box, and the cash shorten over accommodates that. What if instead of $2, we have $4 remaining The process for the journal entry is the same. The debits will remain unchanged. Our credit to cash will now be $296 because that's the amount we need to withdraw from the bank and add to our remaining $4 to get back to $300 that should be in the box. With $297 in debits, but $296 in credits, we need a $1 credit to cash short and over to make our entry balance. Once again, you can sum the cash left in the box with the amounts on the receipts, and they'll sum to $301, our overage. All that aside, the key takeaways for replenishing petty cash are as follows. Debit the amounts on the disbursements report to the appropriate asset or expense account. Credit cash for the difference between the petty cash fund balance and the cash remaining in the box. Be sure to credit cash because you're taking money out of the bank to put back in the cash box. Do not credit petty cash. Plug any debit or credit necessary to make the journal entry balance to cash short and over. A shortage will require a debit because it's like an expense. An overage will require a credit because it's a revenue. What if we decide that $300 is too much to keep in the office, and we think $250 is more appropriate? In that case, we can reduce the petty cash fund balance by debiting cash and crediting petty cash for $50. Once we post to the ledger, the petty cash balance becomes a $250 debit. Understand what's happening with this entry. We're taking $50 out of the cash box and taking it back to the bank for deposit in the company account. After this point, at any given time, the sum of the cash in the box plus the receipts should total to $250. What if we decide that $300 is too little and we want to raise the balance to $350? In that case, debit petty cash and credit cash for $50. Post the amount to the ledger, and the new balance becomes a $350 debit. What's happening with this entry is nigh identical to what happened in the entry to establish the petty cash account. We sent someone to the bank to withdraw $50 from the account and brought that currency back to the office to put in the cash box. At this point, the sum of the physical cash in the box plus the amounts on the receipts should total to $350. That concludes this video on petty cash. The next couple of videos will focus on receivables, so you don't want to miss that. Thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up or a question or comment below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting courses. Finally, share my videos with your fellow classmates and maybe your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.